U.S. accounting and international accounting are both accounting styles that are utilized by business owners and investors. While these two methods may seem similar, they are completely different. Despite the initiatives of the Financial Accounting Standards Board, or FASB, and the International Accounting Standards Board, or IASB, major discrepancies linger between accounting methods in the United States and the rest of the world. The International Accounting Standards Board has compiled international practices in the International Financial Reporting Standards, or IFRS. In the U.S., the FASB publishes financial accounting statements that collectively make up Generally Accepted Accounting Principles, or GAAP. In this video, we will take a look at the other differences between the two accounting styles. Long-term investments. Asset revaluation is not permitted by GAAP, however, IFRS permits some revaluation based on fair value, provided that it is carried out on a regular basis. Although technically permissible under GAAP, the depreciation of the parts of long-lived assets is exceedingly infrequent. However, it is necessary under IFRS if the parts of the asset show differing patterns of benefit. The IASB has a separate definition for long-lived investment assets, which are typically valued at their historical cost. In the US, the FASB does not have a specific definition for property used as an investment only. Principles versus rules. GAAP is seen as rule-based, which means that rules are created for particular instances, rather than necessarily encapsulating a greater concept. IFRS is more consistent, because it is founded on principles. Inventory accounting differences. While the IFRS expressly forbids any corporation from utilizing LIFO, Generally Accepted Accounting Principles explicitly permits LIFO carrying the cost of inventory accounting. Instead, international standards stipulate that the same cost formula must be implemented for all inventories of a similar type. In accordance with GAAP, inventory is held at the lower of cost or market, with the market generally being the current replacement cost. According to IFRS, inventory is held at the lower of cost or net realizable value, which is the estimated selling price less any completion costs and other costs involved in making a sale. Key takeaway. If you're ever in a situation where you're unsure of which form of accounting is best for your company, you can always refer to an accountant to help you make an informed decision. As you can see, the two forms of accounting
are similar in many ways, but there are also many ways they differ.